Here's a warning from the top of the financial food chain. The safest part of the global economy, the bond market, may be cracking. And that's a big deal. Bonds are supposed to be the bedrock. They're what pensions, retirement funds, and even whole countries rely on for stability. But if you zoom out, the signals look shaky, and people are starting to notice. Jamie Dimon, CEO of JPMorgan Chase, the bank with $4 trillion under management, basically said, point blank, a crack in the bond market is coming. You're going to panic. Over in Japan, that crack may already be showing. 30-year government bonds have lost nearly half their value since 2019. Interest rates moved just 1%, and it caused massive losses for Japan's biggest insurers. And if it can happen there, it can happen anywhere. Meanwhile, in the US, we're carrying $36 trillion in debt. That's 124% of our GDP, with yearly deficits over 6%. For comparison, economists generally say anything above 3% is unsustainable. And remember, the more we borrow, the more bonds we have to issue. That makes investors nervous, and when they get nervous, they demand higher interest rates. That triggers a feedback loop. Higher rates mean lower bond values. Lower bond values mean more losses. More losses? More cracks. And here's the kicker. Investors are no longer rushing back to bonds. They're eyeing scarce assets like gold and Bitcoin. Because when trust in the system fades, people start looking outside the system. The bottom line? We're in a new era of financial pressure. The bond market, once seen as unshakable, is now acting more like a fault line. If it ruptures, the tremors could hit every portfolio, every institution, every corner of the economy. Stay alert. Stay diversified. Because this bond market, it's not as boring as it used to be. This has been your daily shot of finance.